Welcome to another edition of BCR Webcasting. Next month, we're going to have our 10th Alternative and Receivables Finance Conference. That'll take place on the 27th and 28th of November in London at the offices of Clifford Chance. And one of the sessions for that conference is going to be looking at the progress that's been made on receivables finance as an investable asset class, including private credit interest. And I'm delighted today to be joined by Martin Opfermann, who's the lead portfolio manager for trade finance at Allianz Global Investors. Martin, welcome.
Hi, Mike. Thanks for having me.
Martin, we spoke about this about 2.5 years ago, and I'm interested to get your views as to how things have developed and changed since then. And I'd like to ask you, who are the potential investors now, and why could trade finance assets be attractive to them? When we spoke 2.5 years ago, at that time, you said yields were rising and demand was coming through from the institutional side. How's it looking now? How have things developed since then?
Yeah, absolutely. I mean, things have developed and quite a bit. I mean, we've seen rates rising and now falling again. The relative value attractiveness for the asset class has nevertheless prevailed. Yeah, in the rising rate environment, this was a protection against negative performance, and now in falling yields, we still, as of today, we still have the inverse yield curve, which makes the short end very attractive for the typical fixed income investors. But we still also have a very high pickup versus other credit alternatives in the bond world, such as floating rate notes, ABS, or short-dated corporate credit. So this trade finance asset class is still holding up really, really nicely versus its fixed income alternatives. And that's sort of what creates demand. What we've seen is a general pickup of interest and conversations across the board, pretty much. These are all institutional investors, so this is not retail or high net worth that we are seeing. It's a wide range. We have family offices, we have pension funds, we have insurance companies, we have reinsurance companies, as well as foundations and charities, and corporate treasurers as well. So it's really heterogeneous and diverse, which is good for the asset class, because it means that there is an application for the asset class in different portfolios, in different target return risk profiles of portfolios of investors, and that's what's made it its growth. 2 years ago, where are we now? Fasting forward, we are seeing now also that institutional investors such as the global consultant community is picking up on the asset class, which is a very big step. We're talking to some to get the fund approved for their strategies. So this is going to be sort of a milestone also for the trade finance fund world to get strategies like this approved by them.
So when you say consultants are beginning to get involved, is that from the point of view of an advisory basis in terms of recommending to their clients?
Yeah, their business model is to advise institutional investors on asset allocation, and if they approve a strategy and support it, a sector and certain funds in the sector, then that is a sort of stepping stone for an asset class. So we're very optimistic about the next outlook, the next future.
And you mentioned sort of fairly wide range in terms of investment targets, depending on risk appetite. And last time we spoke, 2.5 years ago, there was quite a range of returns, potential returns, from low risk returns from 60 to 90 basis points, up to 150 to 200 basis points, and maybe beyond. Is that typically where it lies around now? Interest rates risen, they're coming down again, as you mentioned.
I mean, that's sort of what's available. I mean, it is like fixed income, an asset class which offers all sorts of risk return combinations, and at the very low end in the insured space, so credit insured trade receivables, you have that 50 to 90 bip pickup over risk-free rate. That's still prevailing. Yeah. And on the high risk part or high return part, you still have the commodity or emerging market commodity trade finance type in the ranges of 8 to 15% return. So that's all still there. And then in the middle, you have defensive strategies that can earn you anything between 100 and 300 basis points of return over risk-free, and that's broadly still there. And we've seen a few players in the market that have ran their strategies successfully, and they're still around, and demand is picking up. We now, also this is a bit on the sentiment from investors as well. Greensill has been many years back now, and there's now an offer by UBS to compensate investors who had been in those funds. So this is now also a positive sentiment for the sector that this chapter is now finally over.
So you think there's more confidence among investors now?
Yeah, there's, I mean, confidence / track record, right? Every one of our peers now has more years of proven performance track record, and that in a new asset class for institutional investors is the holy grail, right? You can show a lot of investment opportunity in the future to investors, but to really convincing is to have a track record that dates back many years. Through different crises, and we now, as an industry, we now have that. We have the Ukraine war, we have COVID volatility, and so on. And we've seen the different volatile events in between, which didn't affect us, which affected the bond world quite a bit, and that shows the case for our universe, basically.
So I presume, Allianz, you're talking quite positively about this sector growing and developing. I presume Allianz will stay in the sector and are hoping to grow it and develop it further. You see a longer term future for this type of.
Well, I can't speak for Allianz Group, but I can sort of, as Allianz Global Investors, we're committed to the strategy and want to grow it further. I mean, we have a team that in place for many years. We have the strategy that is live, so we want to build it out with our partners, and all looks reasonable, positive, which is great.
Why might investors be a little bit cautious or maybe slightly reluctant to get into this space? It's not mainstream yet, but maybe it's heading in that direction. But it's quite complex, isn't it? It's not always easy for investors to understand how trade finance works and all the various labels and the descriptive aspects and complexity.
Yeah, the branding is quite. There are. I mean, there are some obstacles to bring it into a portfolio allocation, and I think the first challenge is to find the right spot in a strategic asset allocation. Yeah, is the asset class private debt? Does it go into the private debt bucket? Does it go into the fixed income bucket? Does it go into the cash bucket? And frankly, we have clients, institutional investors of different backgrounds, that put it in either one of them. Yeah. So for some it is just handled differently. But that is a conversation that each investor needs to have for itself. Where do I put it in my strategic allocation? What does it replace? What is the attributes? 2.5 years ago, most people had it in private markets, a private debt section, yeah, in this bucket of portfolios. Nowadays, we see it's more seen as a fixed income asset, so basically substituting short-dated bond funds or short-dated credit exposure in the bond world, and that's the trend that has been shifting a little bit. But we still see some higher risk appetite investors who say, well, for me, this is just cash, yeah, which is from a liquidity point not, but from a risk point, some parts are really very close to cash, yeah. But this is really the part where each investor will have to say, okay, this in my risk return framework allocation, it fits there. That's the first hurdle to overcome. And then the second, as you mentioned, is understanding what we're actually buying, what was actually done. And here, I mean, having worked with 29 different sourcing partners that we have live and work with on a regular basis, I mean, every party calls things differently, documents things slightly differently, very similar, but the nuances are always a tiny bit different. And that obviously needs education, understanding, and about what bundles of risk are we actually taking, and that's something that where asset managers can help. I mean, that's ultimately where investors need to say, okay, that's where we trust our asset manager to have gone through that DD and have that understanding, because yeah, every trade will be a nuance different from the other trade. Yeah. Again, that's the track record that helps the history that this can be managed in a proper fashion.
Yeah. Well, it's an interesting subject, and of course, it has big potential implications for trade finance providers. So we certainly will look forward to hearing more from you, Martin, at 10th Alternative and Receivables Finance Conference, which, as I mentioned, is next month on the 27th and 28th of November in Canary Wharf at the offices of Clifford Chance. Martin, we look forward to that and to hear you again and your fellow panelists. And thank you very much for your time.
Likewise, looking very much forward to meeting you in person again and the other panelists as well.